This is Wall Street Week. I'm David Weston, bringing you stories of capitalism. Whether it's DEI or electric vehicles or the rush to southern Florida, every week we see some crowded trades getting reversed. We tell the story of what happens when the bandwagon everyone jumped on suddenly slows down. Plus, President Trump is doing his best to reverse the trend of an ever-growing federal government. Where does that leave the D.C. real estate market? And drill, baby, drill is another theme of the Trump administration. But it's not at all clear that the oil companies and their shareholders will be joining in the chant. But we begin with the big story of the week for global Wall Street.
You see weaker growth but higher inflation. They kind of offset. And also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there is a level of inertia where you just say, maybe I'll stay where I am. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored.
Larry Summers of Harvard is our special contributor here on Wall Street Week.
He should be focused on the fact that we had a shock that pushed inflation up and growth down, and that's a bad supply shock. That's a self-inflicted wound, and it tells us that policy is moving in the wrong direction. And it's a shot against the bow of the Trump tariff policies, which clearly have materially changed the picture in a way that the Fed is seeing both as more uncertain and more problematic on both their key objectives.
I was struck by the fact that in the projections, the growth projections were taken down, not just for 25, but 26 and 27 as well. On the inflation side, it was really mainly in 25, and you heard Chair Powell say maybe the effects are transitory, using that word we've heard before.
I would have thought the chairman would retire the word transitory. That is perhaps the most notoriously ill-chosen phrase of his excellent 7.5-year run as Fed chair. And so I was astonished to see him resurrect that concept. He might turn out to be right, particularly if the economy suffers a recession. It's conceivable that the economy won't suffer a recession and he'll turn out to be right, but it's certainly not something that I would want to bank on. There's another point that I think most observers have missed, which is if you look at the dot plot, the median, the person in the middle on interest rates, has not changed. That's what everybody's highlighted. But the average, if you just take an average of everybody's forecast, that's moved up a fair amount in the last few months, reflecting the fact that with these tariffs, with the inflation they're bringing, there's less confidence on the part of the Fed that they're going to be able to cut rates, even as there's a prediction of more cyclical weakness in the economy. So this is clearly a more worrying picture than we had in December, and there's only been one important change, and that's been the change in tariff policy and, more broadly, the political approach to economics.
One of the themes throughout what Chair Powell had to say was uncertainty, because there's the concern about what is being done. There's also the concern about what we don't know around the corner. We have an enormous uncertainty. What does that do to the economic machinery in and of itself?
Nothing good. Look, the task of policy is to reduce uncertainty. The task of policy is to give confidence about sustainability. When policymakers are confidently promising a stock market boom when they come in, and then they deliver the 11th fastest correction in the last century, one of the fastest corrections in the last century, and then they discover that they think the economy needs some kind of detox, and they don't give any indication of whether it's going to end, and they vow unprecedented levels of protection to be declared on a date in the future. That is introducing uncertainty, not reducing uncertainty, and I think that's really quite dangerous.
I am struck, Larry, that as we talk about what the Federal Open Market Committee did, we're talking about the White House almost exclusively. And talk about more broadly what we are seeing coming out of the White House, how it is could affect the economy. For example, this week, we had the president say, I'm going to dismiss 2 sitting FTC commissioners, even though they're an independent agency. It's a concern that might extend into the Federal Reserve. What are the ramifications throughout the government and the economy of the actions we're seeing?
Let me speak very directly, David. We are not there yet. But every week for the last 2 months, the risk of an attempt to impose authoritarianism in the United States have gone up. The dismissals that you mentioned are one example. The lawless cutbacks of spending are another example. The impositions and threats to universities with no process, nothing of what is required in Title VI law is another example. The steps with respect to expelling people who are here without the process protections contained in law are another example. The assertion that if the president does it or to help the country or save the country, it can't be illegal is another example. The flirtation with fascists abroad, such as the AfD in Germany by the vice president, is yet another example, and there are many more. We have not crossed a Rubicon yet where court orders are being defied. That hasn't happened yet, but we are getting much closer to that Rubicon. The so-called Overton window of things that are seen as possible and imaginable has broadened. And ultimately, that is going to be alarming for what America is, and therefore potentially going to do grave damage to our economy and the world's. We are not there quite yet, but I have to say what was a possible concern 2 months ago now seems to me to be a genuinely alarming prospect. And that should disturb and worry every investor, and our country's leaders in the business and financial community who know how much they have depended on the rule of law should be organizing to resist what could be an extraordinarily damaging long-term change in policy. It takes decades to grow a forest and a few minutes to burn it down. Something like that is true with respect to our nation's credibility and commitment to rule of law. And so I do not remember in the last 50 years a more alarming moment in terms of the approach that the U.S. government is taking to our democratic institutions.
One way that President Trump says he'll get inflation down is by producing more oil. But those doing the producing aren't so sure they want to go that way, no matter what regulatory relief comes their way. That's next on Wall Street Week. This is a story about irony. For years, the oil industry complained about all those federal regulations that kept them from pumping more into the market. Now they have a president who wants to give them what they've wanted. And our colleague Alex Steele has the story of why they may be having second thoughts.
As the Rolling Stones say, you can't always get what you want, and President Trump wants energy companies to produce more oil.
We will bring prices down, fill our strategic reserves up again right to the top, and export American energy all over the world. It's called Drill, Baby, Drill.
One of the pillars of President Trump's economic plan is ramping up U.S. energy production. Pump a lot of oil, lower gasoline prices, people have more money. Citi says that oil at $60 a barrel and the U.S. economy could see as much as $100 billion of a deflation impulse.
I always say people may not know their ATM PIN number or their anniversary, but they know to the cent what gasoline prices are that day. And it's really because it's the only price that we see written in 10-foot-high letters.
The problem is people might want lower oil prices, but oil producers want returns.
At the end of the day, oil is a business. Companies have to make investment decisions based on what they think is a price that they will be able to achieve for this product that they bring on.
Saad Ram is the chief economist at Trafigura, one of the biggest commodity trading companies in the world, and it's his job to forecast prices.
Dallas Federal Reserve just recently did a survey of the companies within its region, mainly the oil producers, so asking what do you think average break-even prices are for the different plays. And ultimately, the lowest one came in at about $60. So really, anything at 60 or below is really going to then impact decision-making and the profitability of these investments. Even when oil prices averaged $80 last year over the course of the entire year, really crude oil production really only grew about 200,000 barrels a day. So that's telling you that even at $80, which is a much higher price than that range, companies are not deploying a huge amount of capital.
This time, oil companies will prioritize shareholders' returns over most everything else, unlike last time when things ended with a spectacular crash in oil prices, bankruptcies, and burned investors.
We were all caught up into Wall Street and the multiples that were being paid. It's like it reminds me of the tech side now. And so it was the same thought process that went through our minds back in, called it the 2010 to 2019 time period. Pioneer was trading at 10 times EBITDA back in 2012 to the 15 time period.
Scott Sheffield was CEO of Pioneer Natural Resources for over 20 years until he sold the company to ExxonMobil for $60 billion. He's one of the original wildcatters, a risk taker who drills for oil in unproven areas. What led to the massive amount of exploration and development? Like, was it also cheap money?
We went public in 1991. The reason you go public is to be able to raise capital. We ended up raising probably 5 to 6 billion, probably more than top 1 or 2% of all public independents, to acquire opportunities, to grow. And then eventually the shareholders said, Scott and the rest of the independents, live within your cash flow. So create a free cash flow model that returns us dividends, returns us buybacks, and live within that cash flow to be able to move forward.
Sheffield and others like billionaire Harold Hamm were credited with the innovation, technology, and perseverance that led to the shale revolution, unleashing a flood of American oil into global markets.
You know that going in, there's a certain amount of risk there, but you could also be rewarded greatly. As you know, we took a lot of risk with the Bakken, 1.3 million acres, and so that paved the way, that paved the future.
In 2008, oil prices spiked to $140 a barrel and mostly stayed between 80 and 100 between 2010 and 2014. Capital markets were wide open and companies took advantage. U.S. independents raised a whopping $371 billion in debt.
We had Arab Spring, so we were in the $100, $110 to $120 range. So at that point, people were saying, great, future barrels at those prices, but with a break even that is, $50, that spread is enormously profitable.
The oil came fast, as did the cash, and neither lasted. U.S. shale has a quick initial production and a steep production decline. When shale oil is first produced, it's like the opening of a fire hydrant, a ton of oil really fast. Once that initial flow subsides, the oil slows down. In order to keep the same net amount of oil flowing, producers needed to keep pouring money into new wells.
You had to produce, basically just holding leases. So you had to drill. So it wasn't whether you liked it or not or wanted to, but you're trying to perfect those leases that you've taken on. So did that always serve shareholders? I think it did, because you was preserving the future for them. But some of them didn't see that. They wanted immediate returns.
When oil prices crumbled, the party ended.
I think the washout really was that drop in 2014. So we went very rapidly from about $110 down to, at one point, I think it was, the low was about $28, right? So imagine any industry where that happens, but in particular in a capital-heavy, capital-intensive industry that has long lead times, where you have to invest over a period of years, that obviously really, was the reckoning behind that.
Equities tanked. The XOP, which tracks publicly traded U.S. oil and gas producers, lost over 90% from its peak in 2014 to trough in 2020. High yield spiked to almost 22%, and there were more than 200 bankruptcies.
We came down very, very sharply to the point where we weren't just below break even, we were getting to what we call cash costs. So basically just the amount to keep the lights on. There was certainly a lot of loss of shareholder value, which is why I think shareholders are now saying, if you're making money, I'd prefer you return it to me now.
Shareholder pressure can be stubborn, and so is economics.
I think ultimately it is inflation across everything. So whether it is materials, whether it is labor, you're starting to see those things move higher. And I think ultimately also you're seeing a lack of that talent coming into the industry. But you also then look at what's happening around increased costs around steel, potentially tariffs having an impact, and all of that starting to add up.
There are things that could help producers drill at $50 oil. Lower taxes, less regulation, cheaper federal land leases, and less perceived hostility from the government. Natasha Kaneva is global head of commodities at JP Morgan.
We do believe that it can happen. So first of all, the $50 is a target. Yes, at the moment, if you look at the break-evens, they're at about $55. What the administration can do, they can bring the cost of production, the cost of drilling lower. So we actually believe that 45 is the new 55. So we believe that they can bring the cost of drilling by about $10 lower.
Kaneva gets there in three ways: lower royalty fees on production on federal land, corporate tax reduction to 15% on things produced domestically, and bringing back the bonus depreciation from the 2017 Tax Cuts and Jobs Act. This lets businesses deduct 100% of certain capital investments. That alone could cut break-evens by $9.
Yes, they have this additional $10. What they can decide is they can say, okay, we'll pay ourselves more dividend. We'll increase the dividend yield. We'll increase the buyback, or all other things that they can do with this money, or they can say half of that actually will go into the ground and will increase production. So this we don't know. What we're saying is that we believe it's doable.
Kaneva says you don't need to spend that much money to produce more oil.
Our numbers are showing that $1 million spent today versus 2014 gives you about 86% more production. So pretty much you're doubling production through efficiency gains.
The math says producers can drill more with less. Now shareholders have to let them.
Now, maybe it takes a change on the part of shareholders to then say, actually, what we do want is to go back to production growth. Because production growth, obviously, ultimately, that's future revenue that's coming in. And I think we've been in this period where they're not valuing that production growth. And partly it may be because of concerns around peak oil demand.
So if President Trump could incentivize long-term oil demand growth past 2030,
that might change things. Whoever's in the White House has a bigger impact on the demand side of the equation than on the supply side of the equation.
If more oil production isn't the answer, an alternative for President Trump might be gas, baby gas. In a recent speech at the Premier Energy Conference CERAWeek in Houston, Texas, the Secretary of Energy, Chris Wright, mentioned LNG or gas 8 times and oil only twice. It was a fiery speech that had industry leaders abuzz.
President Trump immediately ended the pause on LNG export permits. Today, I can announce our 4th action in this regard, improving the Delfin offshore Louisiana LNG export terminal.
Oil gets all the headlines, while U.S. natural gas production also sits at a record 107 billion cubic feet a day, up 90% since 2008.
Scott Bessent's the three-point plan is considering, yes, it's about 3 million barrels per day of oil equivalent growth between now and the end of 2028. So we actually believe the true number is closer to 4 million barrels per day of oil equivalent. Majority of that would be done by the gas, actually. It's not by the oil, but by the gas.
It's a lot harder to export natural gas. You have to freeze it in order to ship it, with a similar process on the importer side. Those facilities are expensive to build, but more and more are coming online, helping to expand America's potential. By 2030, the U.S. should have over 250 million metric tons of LNG export capacity a year, based on current regulatory approvals.
I think LNG has a great future. It could be more focused on NGLs, liquids, and could be more focused on the natural gas side versus the oil side. We don't have many oil plays left in this country.
The biggest problem for producers, either oil or gas, is infrastructure, moving the hydrocarbon from the wellhead to the Gulf Coast or your local utility. The permitting process is pretty much hated by all energy folks, oil, gas, and renewable alike.
Permitting is difficult for many different reasons, but one of them, it's not in my backyard. And because of that, there's a lot of those environmental considerations that need to be solved for and decide exactly how you approach that.
Many pipelines have been scrapped or held up in courts for years, leading to bizarre pricing, like $20 gas in the Bronx versus $3 gas in Chicago.
It's crazy. I mean, you get some markets that, even get into a negative market. If you can't get your product to market, it does distort it in a lot of different ways. And it also distorts it to the consumers.
If we think away from drill baby drill, what's something better? Is it gas baby gas? Is it dig baby dig? Is it build baby build?
The reality of that is that if we want to achieve all those targets that the Trump administration put forth, yes, and it's a lot of that, bring inflation down, yes, we have particular objectives in terms of trade, we have particular objectives in terms of geopolitics, so it's definitely drill baby drill, it's definitely dig baby dig, it's produce baby produce. We have all of that in the ground, but we need to be able to move that, and we need to go through the approvals of those pipelines, and so work baby work.
And at 79, Harold Hamm is still working.
How do you feel? Like, are you as bullish on the industry as you've ever been?
Probably more so than I've ever been. It takes both oil and gas to make this industry work. And it's good to see the demand coming on for natural gas with the data centers, AI demand. I think that's a good plus. Here in 4 to 6 weeks, we've seen a complete change in the outlook for natural gas in this country. I've seen nothing that's going to slow down demand growth on the oil side.
Maybe the Rolling Stones were right. You can't always get what you want. But if you try sometimes, you'll find you get what you need. And in this case, what we just might need is more gas drilling and pipelines instead of oil. In that case, everyone wins. Shareholders, President Trump, and us.
Coming up, getting on the bandwagon just as it's coming to a halt. We bring you the ironic story of 3 trends: electric vehicles, DEI, and moving to southern Florida. This is a story about getting on the bandwagon, something that feels so good when everyone is doing it, but that may get awkward when people start jumping off. Electric vehicles, diversity, equity, and inclusion, and moving to southern Florida have all had their time in the sun, but all are now seeing some shade coming their way.
The historical track record for automotive startups in the United States is extremely bad. The only 2 American car companies in history that have not gone bankrupt are Ford and Tesla.
Traditional automakers followed Elon Musk in betting big on EVs. In 2021, GM announced that it would end production of all of its gas and diesel-powered vehicles by 2035 and go fully electric by 2040.
Well, I think the car companies were responding with enthusiasm and hope for the new vehicles.
Mary Nichols is a believer in EVs. During her tenure as the chair of California's Air Resources Board, she implemented the state's landmark greenhouse gas emission standards.
Here in California, the sales rates are almost equal now to gasoline-powered vehicles. In other places, the penetration is going more slowly.
As much as California may be the EV leader, the rest of the country doesn't seem to be keeping up. It turns out that the EV bandwagon needs some support from an infrastructure for charging the cars that just isn't there yet.
It's just that the hope had been that they would really overtake gasoline vehicles faster than they did. And it turned out that there was more reluctance on the part of people, especially in parts of the country where they don't have the infrastructure in place for supporting those vehicles, particularly where the electric utilities didn't step up as fast to provide charging, where building owners in some cases were reluctant. It takes a lot of changes in the system to match what has been achieved over 100 years.
BNEF estimates that the 14 automakers who set ambitious EV goals for 2030 have trimmed back their expectations from 27 million vehicles that year to 23.7 million. One of those pumping the brakes on EVs is Ford, which shelved its plans for an all-electric, three-row SUV last year. CEO Jim Farley took us through some of the challenges several months ago.
Well, first of all, the electric market in the U.S. is about 11% of the market. In California, it's a third of the sales. So it's a huge market, and it's growing really fast. And competitively, globally, I think what's happened is we're in the mainstream customer. And the mainstream customer is totally different than the early adopters. The early adopters, we didn't need to convince them to go charge, or they didn't really worry about resale value, but the customers now do. And that means on us, we have to really transform our cost.
And now it's not just the lack of charging stations that's slowing the move to EVs. We have a new administration in Washington that appears to be reversing the nation's pro-EV policy.
We ended the last administration's insane electric vehicle mandate, saving our auto workers and companies from economic destruction.
It's a trend that I think is well underway, and it's going to continue. I do think that the election sent a message that in some states in particular, this is like a political issue, which certainly is not helpful for any industry. I don't think vehicles are partisan. I don't think there are Democrat or Republican vehicles. You're just looking for the best vehicle that you can get for your money.
Whether powered by electricity or gasoline, the bandwagon of DEI was moving full speed ahead in much of corporate America when BlackRock CEO Larry Fink wrote to shareholders in 2021 that he had a, quote, long-term strategy aimed at improving diversity, equity, and inclusion. 4 years later, Fink was writing to BlackRock's staff saying it was, quote, committed to creating a culture that welcomes diverse people and perspectives, but acknowledging, quote, significant changes to U.S. legal and policy environment related to DEI.
Now, the real question is, what are the policies and practices that organizations should have in place in order for the organization to function effectively? And we spend a lot of time talking to employees and looking at trends across corporations.
Tracy Sitzman is professor of management at the University of Colorado, Denver, and has studied DEI policies throughout corporate America, why we have them, and which ones work and don't work.
And the clear and consistent trend that we're seeing is that employees want to work for an employer that's authentic in their approach to dealing with their employees.
Sitzman's studies have led her to the conclusion that whether a DEI program makes a company run better and ultimately make more money depends on how it is done.
One of the most popular programs for enhancing diversity and inclusion has been diversity training. And this is an example of a program that can work really well or can undermine our workforce. People work hard, they diversify the workforce, and it's successful. By contrast, many corporations implement diversity and inclusion training, and they have a legal undertone as part of the training. So they teach people just how questionable their behavior can become before it crosses the line to being illegal. And when we implement training with an illegal undertone, it actually results in people's behavior becoming more questionable.
But can a program targeting diversity, equity, and inclusion succeed without focusing on identity politics, without setting targets that become a form of quotas? Robbie Starbuck is a faith-based investor who has championed the cause of cutting back on DEI programs.
Even if you wanted to pretend DEI was ultimately a good thing, how can we do the things that we proclaim to want to do without violating the law? And at the end of the day, if you look at these policies like racial quotas for hiring, it's not possible. You can't have a racial quota for hiring and not violate the law. But therein lies the real core of almost every DEI policy in America, is that we should look at people and judge them by their skin tone, which is diametrically opposed to the ideas of the civil rights movement, which was that we're not supposed to judge people by their skin tone. We're actually supposed to look at them as an individual and say, your value lies in your actions, what you can do, your merit. And so that's what we want to see.
Sitzman may not favor quotas, but she readily admits that it's awfully hard to drive diversity, equity, and inclusion without setting numerical targets.
What strategic goal would you set in a corporation where you would not measure it? It just doesn't make sense, right? Without a goal, without some numbers behind something, we don't know how well we're doing, and therefore we're not going to be managing the process towards hitting that target.
In addition to the bandwagons heading toward EVs and DEI, a third movement was Wall Street's migration south to the sunnier and less regulated pastures of Miami. It began earlier, but when the pandemic hit in 2020, its speed picked up. From 2020 to 2021, Florida experienced the largest uptick in registered independent advisors and broker-dealers of any state. And by 2022, it had become home to Elliott Management, Citadel, Icon Capital, and expanded footprints from the likes of J.P. Morgan. Michael Schvo is a luxury real estate developer with properties in Miami and New York.
What's interesting, because that moment in Miami was an extremely surreal experience. You'd have billionaires roaming around North Bay Road, Palm Island, Star Island, looking for homes and literally willing to pay anything just to find a house on the water. Because the idea was nobody with means wanted to stay at home locked up here in New York City. And obviously today, hindsight, things haven't really worked out exactly like that. People moved to Miami. Miami turned to be a real city because you have now real restaurants, you have real people, you have education, you have culture there. But it didn't take the place of New York like a lot of people predicted.
The growing pains come in the form of lack of schools, unfinished offices, and traffic.
Miami has an issue because of schools. It doesn't have enough schools, and that's probably the reason Miami's slowing. There are a lot of companies that would move down if they could get their employees' kids into schools, which is impossible. So you got to be very bullish on Citadel, which obviously left Chicago. I mean, they alone have decided they're going to make Miami into the financial capital of the United States, and they have the power to do that.
So there's a lack of schools in Miami. There's no doubt about that, and that's kind of the main issue. Infrastructure depends where, right? Miami Beach, sections of Miami Beach are okay, but because you have houses there, there's not real main infrastructure issues. The infrastructure issues really became more apparent in transportation. Crossway didn't have enough lanes. There was a lot of traffic. There was congestion because the amount of cars all of a sudden in Miami, people that are coming to work in Miami, is something that Miami has not experienced. And the acceleration of growth was so quick that they did not have the infrastructure. They're catching up now. But again, now less people are working there. So both the infrastructure is catching up, but we're seeing less people there, at least on a permanent base, from what we thought we're going to have, post-COVID.
I wonder the role of demographics and people moving in both the commercial side, the office, and also the residential that you're involved in. Because if you look at the numbers overall, California's losing people. Illinois is losing people. New York losing people. Florida gaining people. Texas gaining people. Does that tell you something about those real estate markets?
Well, yes and no, because it depends who you're gaining. Because if we're talking about commercial real estate, the reality is, are we losing the companies? Are we losing the workforce that's here? Or are you losing, people that are retired and not working and decided it's better to retire in Florida because the tax situation is better there, which is a lot of the reason that you're seeing, people move out of New York and California. There's obviously tax incentive to move to some of the southern states. So I don't think we're not seeing the movement of the true workforce.
Those moving to Miami may have gotten a better climate, but they weren't looking for much different in the spaces they occupy.
So the difference between tenancy in Miami and New York And again, as I said, Chavot operates only in the super prime real estate. So for us, we focus on the psychographic of the tenant. And in our mind, the psychographic of a JP Morgan, okay, is no different in New York than it is in Miami. Maybe the office needs are a bit different, a little bit more outdoor space in Miami. There's that desire to have kind of the indoor-outdoor spaces. But the reality is that you don't change your mindset from a service perspective, from a space perspective, from an environment, because you're in Miami or New York or in San Francisco to that effect.
Whether it's picking up stakes and moving to Miami, or ditching our gas-powered cars, or changing the very nature of our workforce, there's all sorts of good ideas out there, ideas that may make sense. But no matter how good the idea, it pays to have a pretty good sense where that bandwagon is headed before we jump onto it.
Coming up, President Trump has enlisted Elon Musk to cut the federal government down to size. But what does getting all those people off the payroll mean for the places where they live and work? The saga of the Washington real estate market is next on Wall Street Week. This is a story about whiplash, which is what many people in Washington, D.C. may be feeling from the Trump administration's aggressive moves to get them off the federal payroll, even as some pretty wealthy people are moving to town. Our colleague David Gura brings us the story of the changing fortunes of the D.C. real estate market and the upside and downside risks.
This incredible hood, the same company that restored the Cartier mansion on Madison Avenue in New York, there's the same company that came and did all of the bronze and brass working here.
That's what $23.5 million will get you in Washington, D.C. High-end real estate in the area is hotter than it's ever been before. Daniel Heider is a luxury real estate advisor with Sotheby's and the listing agent of 3030 Chainbridge Road in the Kent neighborhood of Washington, D.C.
The volume of some of America's most successful business people is here now. And we are watching the city shift because of it. We're seeing the market shift. We're seeing home prices rise in the very upper brackets. Very recently, I set a record in Washington for selling the most expensive home ever for $25 million.
Commerce Secretary Howard Lutnick reportedly bought this property from Fox News' Brett Baer.
I think of myself a lot as like an art dealer. How we present and communicate a property's value in maybe 30 to 45 minutes if we're lucky to get a VIP family's time, it's everything. Usually, presidential cycles don't impact the market in such a tremendous way. Usually what happens is that when there's a change of administration, the vast influx of folks into Washington's capital region are folks that are coming to rent for a little bit. What we're seeing, certainly in this cycle, is just the opposite. This isn't just a one-level closet, it's actually a two-level.
You're serious?
So this brings you upstairs. This house does not disappoint on any level. And there's a lot more here than meets the eye.
In her 20 years as a housing economist, Lisa Sturdivant of Bright MLS has witnessed 4 presidential transitions.
People bring all cash to the deal. We have less inventory of luxury properties now than we did a year ago. Conversely, the entry-level market and the move-up market, there's more homes available for sale. Part of that is those luxury buyers aren't as interest rate sensitive as an entry level or a move-up buyer is.
The interesting thing to analyze is the tale of two markets. On one hand, you've got this upper end bracket market that is going through the roof right now. And then on the other, you've got a little bit more apprehension due to mostly interest rates being high.
Fears of the bottom falling out of the capital's real estate market started after COVID changed demand and prices.
During the pandemic, the Washington area housing market was sort of on fire, like it was in many places. Record low mortgage rates brought a lot of buyers into the market. Our further out suburbs actually did really well during the pandemic. More people looking for more space, looking to move further out. But even since then, even as mortgage rates increased, we still saw really strong demand here in the Washington area. And now we're sort of in this period where there's a lot more uncertainty in the market.
How much bullishness is there about the future of D.C., given what we're hearing about how radically it might change?
I can tell you, I've lived in Washington my entire life. We are multi-generational Washingtonians as a family. And what I've seen is that Washington is an unbelievably resilient market. well before I was even a licensed real estate professional. You can go back and study the data of 1997 and 2011, and you can see that really what happens in Washington if there's a major global economic downturn is that the Washington market pretty much flatlines. And that, to me, again, is a safety factor of why people would want to invest in Washington. This is the seat of power for the free world. And while parts of it are being downsized, the main apparatus is going nowhere.
In the conversations that I've had, even more palatable than the actual government employees and what reduction in workforce there would be are the government programs and the companies that work based off of that government funding. Without the funding, then they don't have a reason to exist. It's extremely cool.
Philippe Lanier is a principal at East Bank, a DC-based real estate investment company that focuses on urban revitalization.
They have leases, they have commitments to different vendors, and that ripples through the system. So, it's definitely going to impact business in this area.
Trump's administration has already produced potential cuts of more than 100,000 federal workers, including in the Departments of Education and Veterans Affairs. And social media posts claiming that there's an exodus from the city are adding to the perception of instability in the D.C. area. A thread on X with millions of views claims that federal worker layoffs have triggered a $139,000 decline in D.C.'s median home price.
I've heard this word exodus a lot, and I'm just not sure we understand the magnitude of what the impacts will be. And what I mean by that is about 14% of the workforce here in the greater Washington area is a federal government civilian worker. So most of those federal workers are in households where there's another worker, and those other workers likely work for the private sector. The private sector unemployment rate here in the Washington area is less than 2%, meaning the private sector may be eager to hire folks who may be transitioning out of the federal government.
If you look at the city right now, it's dealing with what I would say are three shocks to the system, or a rapid change to the system. One, which is very normal, is whenever you have a change in administration, there's a rotation in and out. So you're going through that change. The second one, which is obvious to everyone reading the news, is you wonder which government institutions are getting smaller or going away, whether people are being let go, and how's that impacting the city's downtown core. The third shock, however, is what is not really talked about as much, is that the amount of people that are coming back to the office with the new administration is massive.
Workers who are keeping their jobs and staying in the area are creating opportunities in real estate.
It is a real fundamental shift in the fabric of downtown DC, and you feel it. You feel it in the metro ridership. You feel it when you walk around. We have a bunch of residential buildings. They're full. There is a high demand for the residential buildings. I'm not seeing what I read in the news that people are being let go.
It's not just announcements about workers being let go. It's also the buildings they worked in. Earlier this month, the Trump administration released a list of more than 400 federal buildings it could look to sell. They've since deleted the list, but it adds another layer of uncertainty in D.C. Some of the buildings that were on that initial list are in parts of the city where there hasn't been much private development, areas that have been home to government office buildings for decades.
They're very clustered within an area. And so that's a challenging valuation exercise, because if you were to take control of one building and fix it, you have all these zombies next to you. So there's no real value in that building unless there's a broader strategy. I would expect that turns into more of an architectural master plan where you understand how to fix the whole thing at once. The properties north of the mall are much more interesting. They're more individual in nature, and there are some properties that are put up for sale that were a surprise to me that you can really do something with immediately. There's real land value, and if you could assemble the capital structure to do something, you could build something that people want.
One such former federal building has already been converted into a luxury apartment complex.
Annex building in the 1930s was used to standardize all types of commodities for agriculture, served tons of purposes throughout the years. This section of the building was more of the warehouse of that building, so it has really lofted ceilings as we go up throughout the building.
The building, called Annex on 12th, opened in December and has 561 dwellings, ranging from about 400 to 1,200 square feet. And it's the closest residential complex to the Smithsonian.
So this next space is called the Vault. And what that is it's a callback to a really cool relic they were able to preserve from the original building. When they were walking the building, one of our developers spotted a vault door on the basement level of the building, and it was in shambles. But he thought it looked really unique. They were able to move it up here, and it's a centerpiece for our speakeasy. So as soon as you open up the door, it's the first thing that you can see as soon as you walk in.
There could be another use for federal buildings for the private sector.
There's an opportunity to bring more private sector investment into the city if the sale of those buildings happens in the right way. One of the things that the greater Washington area has benefited from over the last couple of decades is that diversification in the economy, more private sector investment region-wide. The city itself, though, is still very highly concentrated in federal government activities. And so if those buildings can be repositioned as private sector activities, that feels like that could be a plus for DC.
Even amid the changes in policy, the return of federal workers, their expected contribution to reviving the downtown area, and the hope of attracting more tech companies make this a good time to be in Philippe Lanier's commercial real estate development business.
It's a good place to invest. It also typically has stability, so that's another reason why people like it. It doesn't have height. So if you want to make $1 billion deal in real estate, you go to New York. You don't really go to DC. DC, it's more like the $100 to $300 million size range. But yeah, I'm confident that the city will remain relevant.
The economic tide might already be turning for DC, and its commercial and residential real estate players are hopeful for its future.
The number one indicator that I think most of your audience will agree with, I can have all the best ideas in the world, but it's not going to change unless money comes in.
I just continue to think that Washington is resilient. And I don't believe that everybody who owns a home is going to sell that home. My bet is on Washington. I believe in this city and the capital region. And I think it's going to continue to do well.
Coming up, the world of private equity meets the world of Donald Trump through the eyes of Blackstone's Jon Gray. Investors are coming to terms with what President Trump's policies mean for the economy and for them. As president and COO of Blackstone, Jon Gray has a view from the top of private equity, private credit, and real estate. We talked with him this week at the Economic Club of New York.
Certainly the backdrop is difficult to forecast. There's a lot of volatility given all the policy changes. But I'd start with the economy, and I'd say we ended the year with our businesses with pretty good strength. Revenue growth was high, defaults amongst our borrowers low. So we went into the year, I'd say, in a good spot. We have begun to see some pockets of weakness. No surprise, the number of Canadian travelers coming to the US, businesses that have some portion of their revenue that comes from government spending feeling some pressure, companies in the supply chain uncertain about the tariffs and so forth. Capital markets related businesses, obviously financial services, have seen a pullback given the market volatility. So there's, I'd say, an overall pretty good picture in terms of employment and good momentum, but we are seeing a little bit of a slowdown here. I'd say the positive is that I think the inflation has continued to steadily decline. Maybe not as fast as it was a year ago, but if you look, the Fed has taken inflation from 9 at its peak, now down to 2.8. And if you look at CPI, ex shelter costs, where the government data lags versus what we see in our rental housing portfolio, it's at 2%. They basically hit their target. So it's possible we get a one-time shock with the tariffs, but I think overall the Fed will have some room to lower rates. So if it turns out all of these policy changes lead to more of a slowdown, then I think we'll see a little more of a cushion from the Fed lowering rates. So that's helpful. The other things I'd say that, I'm sort of an optimist by nature, thinking about the glass half full here, is I think the change in regulatory environment will be helpful for businesses, certainly in the M&A area. And then I think the most important thing to not lose sight of as investors is what's happening in technology and how this AI, I think, will impact the productivity of companies and therefore their potential earnings over time. So I think near-term short answer, a fair amount of volatility, maybe some slowdown given what's happening, but probably a better prognosis as we look out over time.
So Jon, take all of that fairly nuanced, complicated view of the economy and put it into the machine you have of deciding how to invest at Blackstone. How does it affect your investment decisions right now?
Well, we try to take a longer term view. We certainly look at the level of prices. So I think what's interesting is in times of high uncertainty, generally prices are more attractive. It's counterintuitive. So when you're in 2000 or 2007 or 2021, there's extraordinarily high levels of confidence, and you're basically assuming all good things are going to happen. And that's when the risk is the highest. Today, when I look at most asset classes, particularly in the private market, there are very few transactions I look at and say, oh my gosh, I can't believe this asset's priced at this level. Maybe there are a few tech companies at very big valuations, or maybe there are certain pockets. But overall, when I look at borrowing costs in the private market, when I look at where commercial real estate sits today, when I look at the companies, I was at an investment committee earlier this morning, prices generally seem fairly reasonable. And I think it reflects the fact that people are collectively a little bit nervous. And so if you have a view that somehow we're going to get through this, that a bunch of this noise in the system will work its way out, and can I buy a good business at a reasonable valuation, then I'd be probably more inclined to lean in, even though we see a lot of things that make people nervous. And what tends to happen is, you know, they leave when the best opportunities exist, they come in when it feels very comfortable. And now just feels like a time where the nervousness is high and the pricing for assets is reasonable.
So take us into one of those investment committees. Share some secrets with us. What do you do? I mean, how do you evaluate potential investments and decide this one's a good one, this one we'd rather stay away from?
Well, it's definitely more of an art than a science, right? And you rely on obviously a lot of analytics, a lot of judgment, but also some gut. I spend my weekends reading investment committee memos. Other people do more fun things, I think. But I love the intellectual challenge of it. I love thinking about what makes a business good. And I'd say what we're trying to evaluate is a few things. Is this business in a good neighborhood? You know, you could be a landline phone company or legacy cable or a department store business where there's a lot of headwinds. Is this a business where there's really long-term strong tailwinds where this sector is going to grow a lot? Things like energy and power today, or data centers or other things. Does the business have a big addressable market? Can it grow? Does it have high margins versus low margins? High margin businesses tend to have a brand or some sort of moat about them that gives them a competitive advantage. And obviously they can absorb a shock much more than a low margin business. Is the business more capital intense versus less capital intense? We bought a number of franchising businesses. We owned Hilton in the past. More recently, we bought Jersey Mike's, which is a great sandwich business. We love franchising businesses because you're just getting royalties. You don't have the capital cost. So you like that. You like businesses with lots of customers versus one customer. You love businesses that have recurring revenues, right? We used to have an M&A business at Blackstone. Every year we had to start over from scratch. Managing capital, we get recurring fees for doing that. So that has a lot of benefits. Do you have stroke of the pen risk? Are you building a business based on one government program that could change pretty quickly? And so you're looking at that, and then you're also looking at it in the context of the price you're paying. What do I have to believe in? And does the business also have a terrific management team? Do I have to take risk on the execution, or there's somebody great here who's running the business and so forth? And very few businesses check every box. And I could probably go through 10 other boxes. But you'd love to have a preponderance of good things where you say the price is reasonable, the business quality is really good, And the tailwinds in this neighborhood are really strong. And if you can buy enough of those, then your chances of success go up.
What about the box of geopolitical risk? Has that risen in priority in recent years? Because there's a lot more geopolitical uncertainty, I think, today than there has been in recent past.
Yeah, it definitely exists. And look, if you have an export-heavy business today into the United States, you know, I can say things about be patient and so forth, but if they're going to put a significant tariff, that's a real issue for your business. You know, when Russia invaded Ukraine and the cost of energy for a bunch of our European companies went up pretty dramatically, that existed. Some of the tensions, obviously, between the US and China over time have created issues. So I think you clearly have to look at that in the mix of where you're investing capital. Some businesses are more exposed, some less, but it's one of the factors you take into account. I would also say, you know, with emerging market countries, thinking about the currency risks, in particular, geopolitical stability. You know, we've seen in some of the Latin American countries a pretty sharp movement left, which sometimes is adverse, obviously, to businesses. So that's one more thing that goes into the mix when you're evaluating should you deploy capital.
That does it for us here at Wall Street Week. I'm David Weston. See you next week for more stories of capitalism.